Our next speaker will take questions after the next speaker. Our next speaker is Mr. David Powell. Mr. Powell is an economist from Bloomberg, and he'll talk about Europe, what's next for Europe. Prior to joining Bloomberg, he worked at Bank of America, Merrill Lynch as a currency strategist. He holds a master's degree from the London School of Economics, where he wrote his dissertation on the creation of a monetary union in Europe, and a bachelor's degree from New York University. Mr. Powell.
Thank you. I'm conscious that we're a bit behind schedule right now, so I've brought my BlackBerry up here, not to check my email, but to make sure I keep to my allotted time here. So I'll try to do that. So as you can see, the title of the presentation is What's Next for Europe? Really what I've tried to focus on is not so much what is going to happen to the euro area eventually. In my view, the present form of the euro area is not sustainable. In order for it to last, there will have to be changes. But those changes are of more of a long-term nature. We see the crisis is already gone for 4 years, and it will probably go on for a long time before we have a view of what the euro area will look like at the end. And of course, there are any number of changes that could be made in terms of potentially some countries leaving. You have a discussion of a weak country leaving, a strong country leaving, or perhaps they all stay, and there's greater fiscal cooperation, etc. So you can go on forever about that. But I think what's most relevant for people who are involved at the financial markets on a day-to-day basis are probably the risks that are most likely to surface over the course of the next 6 months, the issues people are likely to be focusing on the long term, and this eventual shape of the euro is more of a long-term discussion, so I won't focus so much on that. So what I'm going to look at is where the risks lie, and I've adopted the title of the Clint Eastwood film, The Good, the Bad, and the Ugly, to describe the various areas of the Eurozone, and really just a way of saying what the different levels of risks are. So I'll give you a brief outline there, and I'll just move into that right now. So if we have to look at, I think, where what we would call the good, meaning the countries which I think are least at risk, in that category I would actually put Malta. I'll admit to all of you that I didn't know an enormous amount about the Maltese economy, say 1 year ago, but my focus has been kind of on the larger countries in the euro area, but I've looked into it and done quite a bit of research ever since Malta came under the microscope of a lot of people with the debacle in Cyprus. As I've already said, I'm a bit pessimistic about the ability of the euro area to survive in its present form. So I looked at Malta. I probably had somewhat of a pessimistic outlook going into it, but no matter how hard I looked, actually, it's hard to find a problem with Malta compared to the other crisis economies in the Eurozone. And I actually take this quote here from a report sent to me by Bruno just last week, coming from the IFO Institute in Munich, which has a regular assessment of the euro area economies. And I note there that they even place Malta in terms of macroeconomic stability in the same category as Austria and Germany and Slovakia. And one of the reasons I heard the finance minister mention before, Malta, you have to ask yourself, why has Malta been able to survive this crisis in such a robust form? And I think one of the reasons, I think you could probably boil that down to two very quick answers. One is a robust banking system that has not been exposed to the problems that you've seen in other countries, such as Ireland or Spain. But the other is that Malta is not characterized by the macroeconomic imbalances you see in many other countries, which manifested themselves most clearly through huge current account deficits, for example, in most of the peripheral nations. Although the focus on Malta recently has been more, not necessarily underlying economy, but on the banking sector itself. Does it create a risk to the country in the same way you saw in Cyprus? And there are various ways of looking at the banking system and thinking, how does this create a risk? But I think in the present environment, the best way to think about that is, does the banking system become so large that it's capable of bringing down the entire state with it? if there is a problem, which essentially happened in Cyprus. The Cypriot government was unable to even honor the deposit guarantee of the country without external aid. So one metric you could look at when trying to judge the risk that the banking system poses is to simply look at what the government is on the hook for, what are the liabilities in the event of a huge crisis, and they come from the guarantees the government has extended the deposit scheme. So if you look at Cyprus, actually, excuse me, if you look at Malta, it's actually not so far out of line with many of the other quote-unquote safe countries in the euro area. In fact, if you look at Germany, for example, it is essentially in line with it. What you also have to look at, too, is where the debt to GDP ratio is beforehand, because that gives you an idea of the starting point, the extent to which the state can absorb additional debt. So if you take a combination of the deposit to GDP ratio and the government debt to GDP ratio, and you add the two of them together, you can clearly see in the euro area, Luxembourg is the largest there, was followed by Cyprus, and Malta is actually more in line with the average for the euro area, suggesting that the comparisons with Cyprus and Malta are indeed misplaced. However, there is something a little misleading about that number as well, and that is that if you take a country like Luxembourg, you think, my God, look at that number, it's got a huge problem there. But the difference, I think, between Cyprus and Luxembourg, and it comes into play with Malta as well, is that in Cyprus, all of the banks were Cypriot banks, and ultimately the Cypriot government was responsible for making good on the liabilities created by the deposit scheme. Whereas if you take a place like Luxembourg, actually, most of the banks that operate in Luxembourg are not Luxembourgish banks. In fact, according to the latest, according to a report I saw from KPMG, the largest bank by assets in Luxembourg is actually Deutsche Bank. So in the event of a crisis, if there were ever a need for a bailout in Luxembourg, which I'm not saying there is, but if there were, it's highly unlikely, in my opinion, that, for example, the German government would be asking the taxpayers of Luxembourg to make the depositors of Deutsche Bank whole on the deposit guarantee. So I think that's a clear-cut number, though it still has some issues, so you have to look at it more closely to get a solid picture. And that's actually one advantage of Malta as well, is that actually the banking system is not entirely made up of Maltese banks. In fact, the second largest bank here in Malta is HSBC Malta. And the international diversification of a banking system brings some strength, I think, from a systemic point of view. Although not to say that the growth of the banking system hasn't caused or doesn't provide some reason for at least analyzing the situation. If you look at the deposit to GDP ratio of Malta, it has grown considerably from 2005 to 2012, though if it would need, I've done the calculation, probably 20 years of growth at that same pace in order to be put in line with what was seen in Cyprus on the eve of the bailout. And as Professor Bannister has underlined to me in a press statement he sent me from last year, that actually the MFSA took steps quite a long time ago, before this crisis in Cyprus was even in place, to limit the growth of deposits that are actually covered by the deposit scheme of the country. So some corrective measures will already have been put in place. I guess, as Anthony said, again, underlying the utility of a good regulator, one of Malta's strengths. So if you want to compare Malta to Cyprus, one of the advantages is the presence of international banks. The two largest banks in Malta, the Bank of Valletta and HSBC Malta, and certainly it reduces the systemic risks from the point of view of the banking system being entirely of the country, such as Cyprus, where you have the Cypriot government ultimately responsible for it all. And the state of Cyprus was also more indebted before the bailout than that of Malta. You can see if you look at the debt to GDP ratios, already 10 percentage points higher, which put Cyprus in a more difficult position from a level of indebtedness before the crisis even started. And then also, I haven't really done too much of this myself, largely because I focus on more macroeconomic issues and not individual analysis, not the analysis of individual balance sheets, but also you have to look at the stability of the bank system, the assets they hold, And as the central bank governors pointed out here in many cases, that the Maltese banks don't have any, or if they do, very limited exposure to the securities issued by the program countries, which was, of course, a big weakness of the Cypriot banking system, the large holdings of Greek bonds that they had there. So if we come back, though, and we look at the next level of risk, so just to kind of conclude that, in my opinion, the euro area has a number of problems, but Malta is really not one of them. From a stability point of view, it's probably in the category of the healthiest countries. If we look at the kind of the bad, which I put as the medium-term risks, the kind of medium level of risk, not the riskiest place in the Eurozone, but still certainly cause for concern, probably looking over the next 6 to 12 months, of course, you have Italy in that middle category. And in Italy, as has been frequently pointed out, one of the advantages is, of course, the government is not running any kind of huge primary budget deficit that needs to be closed. So the current fiscal management of the country is in relatively good shape. The only problem is it has such a large stock of existing legacy debt that you don't need a large recession, or you don't need a large change in any of the factors that go into debt sustainability that before that level of debt to GDP starts to rise again. So for example, when you look at what goes into looking at the debt to GDP, it's of course the present level of the budget deficit, the average cost of debt, level of inflation, and the level of GDP growth. So for example, in a place like Italy, when you have 1 year of recession that's larger than expected, it all of a sudden can wreak havoc on the debt to GDP ratio because the level of existing debt is so high. And we're seeing that play out right now with the recession that had been anticipated, I think 12 months ago, having turned out to be much deeper than originally thought. So of course it poses risks to the sustainability of debt, and we'll have to see how that plays out. But certainly the deep recession there creates a large risk, and it essentially leaves it vulnerable to a number of shocks. And what concerns, I think, most international investors about the situation in Italy so much is that already when times were good, it essentially it didn't grow at all. If you look throughout the course of the 2000s, Italy is the blue line at the bottom there, and that's the level of real output, even during a period of a credit boom where everything in the world seemed to be fantastic. You can see that the Italian economy hardly managed to grow, and right now its level of output is essentially in line with where it was when Italy joined the monetary union. So it puts into question the ability to grow now, which obviously is a much more difficult environment. And probably Italy's biggest weakness is this is just mere contagion. If you look at the correlation between Italian bonds, Italian sovereign yields, and Spanish sovereign yields, they tend to be very, very high, and that has been the case throughout the crisis. So even if Italy itself isn't the center of the storm, unfortunately, it gets often categorized with Spain as the problems in Spain flare up there. And Spain, I would say, is probably in much worse shape than Italy in terms of the ability to survive the present crisis. Problem with Spain, actually, if you look at its debt to GDP ratio, in contrast to Italy, where because of Italy's large primary surplus, the actual debt to GDP ratio is scheduled to peak and come down over the next few years. But if you look at Spain, there's no improvement in sight. I have there on the left-hand side the most recent debt to GDP ratio forecasts of the IMF, and you can see now that the depth of the recession has caused a revision there, which fails to have that debt to GDP ratio start to come down over the forecast horizon. The IMF has historically avoided using the terms solvent and insolvent. They don't really use those terms, largely because it's very difficult to say what makes a country solvent and insolvent. With a company, it's more difficult. You say if the liabilities are greater than the assets, then it is insolvent. With a country, the greatest asset of any country is the present value of future tax revenue, and that's, of course, subject to the level of taxation, level of growth. In other words, it's very difficult to value. So you can't say with any degree of certainty, yes, something is solvent or insolvent. But what the IMF tends to do is it looks at the debt to GDP ratio, and it says if that number starts to come down over the forecast horizon, then the present situation is sustainable. If it's not, in other words, if there's no improvement in sight, then it is unsustainable. So by using the IMF's own definition, the situation in Spain right now is unsustainable, and largely what has caused those revisions to the debt to GDP ratio is the outlook for the primary deficit, which is proving nearly impossible to close, even after having had very, very sharp reductions in government expenditure, largely because tax revenues continue to fall as the economy slips into recession. So from my point of view, Spain is the most dangerous right now in terms of crisis countries. The whole world started to focus on Slovenia too. You may have seen in the FT several weeks ago, there was this big kind of one-page article where it puts Europe's 4 major problems, Slovenia, Malta, the other was Latvia, I can't remember, and Cyprus, of course, which to me there was no basis at all behind categorizing all those countries together, apart from the fact maybe they're all small. The only thing they had in common. But Slovenia, quite worrisomely, looks a lot like Spain. It started out this crisis with a debt to GDP ratio that wasn't so high, in fact very low for European standards, below 30%. And even now, it's not so bad, it's manageable. The problem with Slovenia, of course, is that it has a banking system that is harboring huge losses, and there is very little transparency there in terms of what the actual numbers will be. So you can see the OECD has come up with all these scenarios here of the recapitalization needs of Slovenian banks. They have this bottom-up baseline scenario, bottom-up adverse scenario, et cetera, and then one with a top-down approach. And so even the worst one is only about 5% of GDP, although the history of these estimates show that they tend to greatly underestimate the recapitalization needs, and somewhat reminds me of Spain, which in 2011, I believe the finance minister was still saying that the Spanish banking system was solid and wouldn't need any recapitalization at all before they received 100 billion euros, of course. So Slovenia remains in one of those countries very much like Spain, which is plagued by potential large losses in the banking system. Also, Portugal is a similar situation, I would say not to Spain, more to Greece, in that the economy there, of course, the biggest problem is the economy remains in free fall. If you look at Portuguese GDP right now, it's at even below the level when it came into the monetary union, and the economy is showing no signs of stabilization at all there. So the question is it going to be able to access the markets again in 2014 when its bailout runs out? Looks highly unlikely. Mario Draghi has clarified on a number of occasions that Portugal will not be able to access the OMT. It is only for countries that have not already experienced a bailout, so they don't have access to the ECB's bailout mechanism. And of course, the problems with the Constitutional Court there, which have ruled that these budget cuts are unconstitutional, is making their situation even more difficult. And that's all compounded by the low level of growth. And if you look at Greece too, we still have the country that from the start has been the center of the problems in the Eurozone. If you look at a Taylor rule model of the main policy rate required for Greece right now, it is about negative 18%. It's one way of visually showing the extent to which the macroeconomic situation of Greece is completely out of sync with the rest of the euro area. And to me, looks extremely unsustainable within the euro area, even though it hasn't left yet. If you look at the latest indicators for Greece, the economy is still in complete free fall. With the, for example, the PMI for March still showed a 43rd consecutive month of being below 50, in other words, in contraction, and compounding Greece's problems. And now the country is slipping into a period of deflation. If you look at Greek core CPI, nearly negative 2%. So I think I'm getting to the end of my time here, so I'm going to be very quick here. So I'm trying to sum up what does all this mean for the euro area, for the euro. I've put this little roadmap together of how all these factors affect the currency. And I think primarily moving ahead, the ECB has done a good job, of course, in extinguishing the fears of a collapse of the euro area due to contagion and the rising levels of sovereign yields. But the issue that still weighs on the euro area right now is relative monetary policy and how that's going to work. That weighs on the euro. If we look at a Taylor rule for the ECB, we can see it suggests the 50 basis points of interest rate cuts. The consensus is kind of moving around to this. I've seen now most investment banks earlier this week now forecast a cut at the next meeting of the ECB. And if you look at the euro versus the dollar, you can see here that interest rate expectations are likely to continue, I think, weighing against the euro, with the largest difference with the monetary outlook looking very, very different at this stage. Partially because in the U.S. most of the commentators are now looking toward the exit. How does the Federal Reserve wind up QE, and when they're going to do that, with the U.S. economy showing some real signs of healing here. One of the best ways to look at it is the contrast between the unemployment rates between the U.S. and the euro area now, moving in completely opposite directions, while the ECB is still at the very start, in some ways, of tackling, from a monetary perspective, the recession here. I think I'm going to skip through these slides due to a lack of time here and just kind of move to my conclusion because I'm at the end of my time here. So very quickly, what I'd like to kind of conclude here, if we look at the major themes of where the risks lie in the euro area right now, if we have to look at the good, I'd put Malta at the top in terms of low systemic risk. Also, in terms of program countries, I didn't want to spend too much time on it, but Ireland is essentially up there too, showing macroeconomic healing. If we look at the risks that are medium but not huge over the next 6 months, you probably have Italy there. And then, of course, you have France, which I didn't want to discuss too much due to a lack of time, but essentially it's another country where the market is focusing right now. If you look at the ugly, which I would categorize as the countries that remain at high risk, no signs of stability being shown, of course, have Spain there, Slovenia, which is looking quite a bit like Spain, and Portugal and Greece, which still remain in free fall. So the weakness in the periphery, I think, is translating into even weakness of the macroeconomic numbers for the euro area as a whole, with the ECB increasingly likely to ease policy, probably now at the next meeting, and relative monetary policies likely continue weighing on the euro. And so I should say, just to kind of conclude here, when they had asked me to speak about the crisis and what it means for the euro, is that due to the ongoing weak levels of growth and the likely reaction of the ECB, that likely to remain under pressure there for the foreseeable future. So I think I'm right at the end of my time right now, so I'll finish there.